let's have a conversation. I'm gonna let you. I'm gonna drop and let you share your monitor here, Noah. I want to have a conversation on Theta Thursday regarding two very similar strategies, right?
Yeah.
Core strategies for most traders that are theta-based traders. They like their cash flow, and that is the conversation of the naked put versus the bull put. It's I love them both. It's like, okay, which one's my favorite kid? I don't know. I love them both, right? But you can't apply them in the exact same situation. So I want to talk about, first and foremost, Noah, what is a naked put? Then take a moment and describe the bull put and the differences between the two.
Okay. Let me have you share your screen because my thinkorswim crashed too. But I mean, naked, really, I think the biggest question for me on those has always come down to the price of the asset, because it's a question of margin requirement, in my opinion. Because the rules are similar, right? You got a naked, if you sell a naked put, you're usually using a conservative delta, low deltas, less than 0.25, less than 0.20. Same general rules for a credit spread. The only difference between the two trades is whether or not you buy that lower strike price, which fixes your risk and margin requirement. On lower priced assets, I like doing the naked put because I can get the credit and I don't have to spend any money on a debit. And so I can get a decent, nice little return. But when you get to more expensive stocks, doing the naked put, the margin requirement goes up. So the amount of capital I'm tying up, for the amount of money I'm going to get, I usually prefer the put spread. That's my general rule.
Gotcha. Which one now? Give me a couple of the in terms of how you go about naked, but in terms of your analysis. Let's take U.S. Steel here, for example. Okay.
U.S. Steel is a cheap enough stock that I wouldn't do the spread. I'd just do the naked put, because you could afford to own it if it was assigned, and you're going to be able to sell out of money options or pick the strike price you want. With reasonable confidence that, if you end up owning it, you can cover the cost. That's the first thing I look at. With the volatility of U.S. Steel, if I was concerned about the volatility, I might still do the spread, but I don't necessarily think you'd have to if you went low enough delta.
When I'm looking at a naked put, there's a couple of things that come to my mind that I have to answer first before I do a naked put. Number one is the price of the stock, right? And the reason the price of the stock is so important in this evaluation, ladies and gentlemen, is because the margin requirement it takes to sell a naked put. So when you sell a put option in the marketplace, you don't have to buy, you're not buying anything. You're actually receiving cash flow from the sale of the put option. You're basically performing the role of the insurance company here, right?
Yeah.
And so, but to sell that put option, I have to show the market, I have to show my broker that I can afford to buy the stock if I need to. And that's point number two. Do I want to own the stock? If I don't have any desire to own the stock, I really shouldn't be looking at selling naked puts.
Agreed.
Okay.
Yep.
It's a different system, right? There are legit systems on selling put options in commodities where you don't ever want to take possession of it in any capacity, right? But in a naked put on a stock like U.S. Steel or any stock like that, the market has the ability to put you the stock if it goes to your strike price that you've sold. So if I sell the $17 strike price and U.S. Steel goes to 17 or underneath 17, and it does not even have to wait till expiration to get put to you. It can happen before that, right? Depending on,
it's possible, not statistically likely, but it's possible.
No, it's possible though, right? So I have to have a desire to own that stock to do a naked put on a stock.
Yes,
and if you
absolutely.
don't, there's better ways. So number one, look at the price of the stock. So let's take, and these are radical examples, obviously, but let's just take a look at Amazon here. No, without even you answering, I'm willing to bet that you would never do a naked put on Amazon.
Well, yeah, just simply because I could find better ways to use my capital than tying it all up in a $1,700 stock.
Exactly.
It's just a little capital intensive. So yes,
okay.
In that regard, I'm always going to do the credit spread versus the naked put. But I wouldn't mind owning Amazon. It's just for me, it's very poor use of capital.
Oh, absolutely. And I agree with that 100%, because if you look at it like this, guys, you can sell the 1470 put option right here on Amazon. You're going to get paid, $11.80, but look at the margin requirement you have to put up to sell that. You have to put up $14,705 because you have to put up about 10% of the capital that it would take to actually buy it. So when you look at it, you're saying, oh, I get $1,100 in cash flow. That's amazing, but I have to put up close to $15,000 just to do that. So
well, and that means you'd have to have $150,000 in your account to
actually buy it.
To buy it,
right?
And
to actually buy it.
Yeah.
So, but on the flip side, if I right click and I sell a bull put spread, and it's called a vertical credit spread, ladies and gentlemen. And let's just do
I like the little right click drop there.
That's right, baby.
I always right clicking's not a bad thing.
I always right click in teaching mode. You know this. Okay. Now, but if I confirm that, look what happens. Yeah, I don't get the credit that I was getting on the naked put because I'm actually buying options here as well. But I get $100, and now look at my margin requirement. Instead of having a $15,000 margin requirement, I've dropped my capital to, and that's why Noah says it's capital intensive. I drop it down to $900. So on a high dollar stock, most theta traders automatically go to that bull put spread here, right? Let's take a stock like somebody. Let's have the halftime crew. Halftime crew, give us a couple stocks, and we'll break down whether or not we would like a naked put or a bull put. Right, so halftime crew throws them out. Now, Noah, you talked about the naked put. Explain the bull put spread and explain it in 30 seconds for newbies.
Company with the bull put spread, you're still the insurance company, but you bought your own insurance to cover your assets. So that's basically the difference. Is you're making money by selling premium in both cases. But in the case of the put spread, you're buying a contract to insure yourself against loss below that lower strike price. So it limits your exposure to risk. And that's why I think it's more comfortable for most traders on especially on more expensive stocks.
Okay, so let's take a look at a couple right here. And I'm just going to go down the list on some of these from the halftime crew. Immediately looking at Roku, $45 stock. Breaking out of that $45 handle, which is a good breakout, by the way. Thank you for, who was that? Seth, thank you so much. That's a good breakout. I like it.
Oh, so it was on the
I'm pretty sure he got that from the options report this week.
Yeah, I like it. I like it. I like Roku. It's breaking out. Yes, it was on the options report. So in terms of this, it's breaking out, it's confirming. But let's say you're a theta trader here. You're not a directional trader. You're not going to pop call options. You're not going to, bull call spread here. But you like the technical breakout. You like the technical breakout here, and you want a cash flow on it. How would you go about breaking down naked put versus bull put?
Well, in this case, I would be less aggressive as just doing a naked put. I'd probably do a further strike price. My personal rule on stocks is delta 15 or less for naked puts. And then for a credit spread, if it limits my risk, I might be more aggressive still. I still tend to be conservative on the credit spread, but it would come down to, position size, number of contracts. If I did the naked put and I looked at the premium I could get versus if I did the bull put spread and that took less capital, I could increase the number of contracts and still potentially get a decent credit out of that. Mm-hmm. I think it allows you a little bit more latitude on position size when you're doing the spread.
Yeah. Here's how I would go about it. And every trader looks at it a little differently, right? It's a breakout on a confirmation on a reversal pattern. The probability has to be up. And if I come down and I sell that 36 call option, that 36 put option right here. If it comes down to 36, do I want to buy it? I don't. I don't, because the reason I like selling the put here to cash flow is because it's breaking out. And so do I want to buy? And I'm gonna throw it out to the halftime crew. If Roku comes back down to 36, it's obviously not a reversal any longer. So do I want to own Roku at 36? And if I don't want to own Roku at 36, but I still like that breakout, I like that bull put spread already. Now, whether or not we do it, we'd have to run the numbers, right, Noah?
Yeah, absolutely.
But that's one of the ways that I kind of go about it from not just typically from a technical perspective, but just from the fundamental question on a naked put. Again, on a naked put, you have to have a desire to own the stock, right?
Right.
And if I don't have a desire at 36 to own the stock, I'm not going to do a naked put there. I would do a bull put. Does that make sense, everybody?
Yeah, absolutely. Well, in addition to the chart pattern, Matt, I would only do a naked put on something that I fundamentally liked from a fundamental perspective.
Yeah.
Like, does it pay a dividend? I mean, how do their balance sheet look? If it's not a growth stock, I don't want to own it.
Take Toll Brothers for example. Toll Brothers, Tackle 25 stock, great covered call stock. Question: would you rather buy Toll Brothers right now with the intention of doing covered calls on it, or would you rather sell a naked put at 30? And I'm going to be very key on the price level here. Or would you rather sell a naked put at 34? Because I would not sell a naked put at 33. I would not sell a naked put at 32. That's underneath support. I'm selling a naked put at 34 on the confirmation of the breakout at 34. So would you rather buy it on the breakout with the intention of doing covered calls, or would you rather sell that 34 put option? Noah, I want to get your take, and halftime crew, I want to get your take as well. So naked put or buy the stock with the intention.
Well, I think with a stock like Toll Brothers, I think with the Fed's soft language on interest rates, that helps home builders. Seasonal helps it. I think it's got upside potential. So I wouldn't mind owning the stock, but if I can get paid to buy it, I'd rather start out getting paid to buy it. So and this is where sometimes I get more aggressive. I'll sell the at the money put for assignment. Pay me to buy it.
Yeah.
You may not end up owning it, but you get paid. So I wouldn't mind selling the 34, but I might go sell the 35 or 36 and have a higher probability of assignment, but get paid more to do it, and just kind of consider it like starting out a covered call. Because if I was going to buy the stock, I wouldn't cover it till I got a sell signal.
Yeah, and guys, there's no wrong answer here on this. The naked put and the covered call have a very similar risk graph. Noah says he would do the naked put. And again, there is nothing wrong. Noah says, I might sell at the money at 36 to get assigned on that and get paid to get assigned. Nothing wrong with that, okay? The naked put is a wonderful, wonderful, wonderful way of entering into a position that you want to own long-term with the expectation you're going to do covered calls on it. That is what, Blake, and you correctly identified, that's what we call the boomerang trade, right? Where you're selling a naked put with the intention of getting into the stock with the intention to then do covered calls. And if it is ever taking from you in the covered call, you then reissue a naked put at a level you want to get back into the trade with. And we're still in the process of really kind of building that system out. It just takes a lot of time, a lot of back testing, and quite frankly, a lot of headaches in a variety of different capacities, but we will be having that later on this year. So in terms of Toll Brothers, my answer is this: I would rather buy it because of the strength of the breakout we're seeing today, with the intention of having the price go back up into resistance, maybe 38, maybe 39. Once it starts slowing down, sell the call option at that point. But there is not a wrong answer there. Both of them are perfectly fine. It just goes to kind of what your personal read is. If Toll Brothers was not breaking out today, guys, I would say, yeah, sell that put option at 34. You get assigned at 34. It's a great support level. You start doing cover calls after that. So I'm just a little different based on the price action, but there is not a wrong answer there in that capacity. I want to get your take on another stock here, Noah. We're going to look at a couple. ISRG. That one always gives me
ISRG. This is my old go-to. I used to use this for short strangles and things all the time. Earnings plays. Inverted head and shoulders kind of pattern.
Yeah, a little short-term retracement, maybe a potential breakout of 550 coming at us down the road.
Yeah, I would see that as a pretty good candidate for a bull put spread because they've got more expensive stock, pretty volatile, got big ranges. It's post earnings, so I wouldn't mind selling the bull put.
Yeah, it's technically, I think it's a good time to sell one on ISRG as well. You do have this, you have a neutral pattern, But if you look at this, it retraces back down into support, slows its momentum off of that earnings announcement, 2 big up days in a row called confirmation. That is a really good timing when you're looking at potential selling a naked, not a naked put. I would never do a naked put on ISRG. I don't trade ISRG. It was one of those pain trades for me. So when, yeah, it was one of those ones where it's like, oh God, just PTSD right now, right?
Holding a grudge much?
Yeah, exactly. So, but it is in a great setup for a bull put spread. And Noah, when you're doing a bull put spread, how do you go about selecting the strike price and the expiration date?
My rules on stock are it's delta 15 or less. So I go shot by the delta. I'm usually between 30 to probably 60 days, sometimes around that 40-day mark. But I want low delta below a key support zone. I also make sure I'm outside that implied volatility estimate. Over on the right, it shows plus or minus $44. I'd have to be more than 44 points below the current price. So I'd want to be down, if it's trading at 523 now, I'd be pretty comfortable down around 460, no problem. I tend to be conservative on spreads.
Okay. So guys, when you were first new to the market, you really just focus on delta and theta rules. That's what you focus on, right? You focus on, okay, we're going to sell it in this expiration date. We're going to sell it with the 0.150 delta, right? But that's not the analysis that advanced traders go through. Advanced traders, and you just saw Noah do it. Advanced traders look at implied volatility, the expected movement on the market. You can look at that in the probability charts. You can look at that on implied volatility on the options chain. So he said 44 points. I know I need to sell at least 44 points away, right? Noah says that. I also need to sell under a support level, right? So instinctively, Noah said, all right, I'm not going to sell the 480 because I know that's just going to be too tight. I know I have to sell at least underneath that 470, that 470 handle, because 470, if I will remind you, is a support level, right? And that 470 is also right at that $44 projected movement. Okay, so instinctively Noah he just goes through that analysis very, very, very quickly, but instinctively he says, I'm going to go down to that 460. I know it's underneath my 0.15 delta. I know it's underneath my support level, and I know it's underneath the projected expected movement one way or the other based on implied volatility. That's how professional traders go about analyzing the strike price they're selling. It's not solely based on the delta. The delta rule is kind of where we go to first, and then we look at our support levels, implied movements, and we always revert to conservative. And guys, as new traders, you get a little greedy sometimes with those deltas. You see the ROI projection on a 25 delta, and you're like, oh my God! And I'll just go do it on ISRG right now. Let's go see 24 delta here. Okay, on a 10 points, on a 5-point spread, mid price 96.
I think you got that as a debit.
Oh, I do have that. As I was like, wow, that's not accurate.
You hit
Fine.
buy vertical versus sell vertical, I think.
Yeah, it's sensitive. The right click is sensitive. Okay, so you're getting 96 cents, guys, against a $5 credit. You're getting a 20% ROI. And I want you guys to think about these numbers. You're getting a projected 20% return on investment on a 76% expected probability. And as a new trader, you look at that, oh, I got 76% probability to make 20% ROI. I'll do that all day long until you actually do that. And you get just absolutely whipsawed because you don't understand implied volatility movements. You don't understand probability of touch. You get so excited over that ROI projection that you miss out on that. That's not what makes this work. It's the probability that makes this work. And so as veteran traders, we realize very quickly, always revert to lower deltas, right?
Yeah, the market only teaches you that lesson once or twice before you figure it out. They can match all the numbers from like a playbook standing. Like your playbook might say delta 25 or less, but that's a basic guide. Experience, like I think John said there, delta is just your Sherpa.
It's a great quote.
you still have to do the work. I think that's right. You got to make sure it meets all your other criteria. So
Absolutely. Absolutely. Well, guys, that's it for the halftime crew and halftime report for tackle training on this day, the last day of January 31st, 2019. Guys, thank you so much for being the best part of tackle trading. Thank you so much for coming out and supporting this. Thank you for the likes and the Fibonacci retracement right at 50% right now. We enjoy that. So if you did enjoy the show today, you learned something from it, you got some helpful tips, go ahead and give us a like and help us get the good word of tackle trading out there. Share it with somebody else. And for those of you who are not halftime crew, not part of the pro membership at Tackle Trading, and want to find a community that of like-minded investors, like-minded traders, all helping one another out, you have found that in Tackle Trading. You can get a 15-day free trial over there at tackletrading.com. And we hope to see you over there in our community. You guys are amazing.